You must know your investment risk score. Welcome to another episode of Can I Retire? If we haven't met, I'm Tony Hansman with Guardian Financial. We are a wealth management firm, and we help people just like you who are in or near retirement. Today, I've got another hypothetical case for you, so let's jump right into it. You can take a look that we've got Chris, boy or girl, doesn't matter, 63 years of age, and she is going to live to the age of 94. So over 30 years in retirement that we got to make sure that she never outlives her income. She's in the right portfolios, that she pays the least amount in taxes, that we maximize her Social Security, all of those things that come with retirement planning. So if I come down here, we're going to go to the next button. We're going to take out look at what Chris's needs, wants, and wishes are. So you can see that Chris only needs about $40,000 a year to live off of, and her Social Security is almost this amount. So she's not really going to dip into her assets. Those are going to be there for her for a rainy day or for an emergency. Her wants, in 2033, she says, hey, Tony, I think that I need a new car. And this is $30,000 in today's dollars. So there's going to be some inflation on there, so that dollar amount is going to increase, but that was one of her wants. And then wishes. She knows in probably around 2035 that she's going to have to do some home improvements, upgrade the kitchen cabinets or do some painting and some of those things that were important to her. But let's dive in and let's go take a look at her net worth so you understand what we're talking about in this hypothetical case. Here we are on Chris's net worth page. You can see that she has a net worth of $1 million. Down here, I've got $800,000 in assets, and what that represents is about $600,000 in IRA money that she has not paid taxes on. She's gonna have some tax problems here, but we're gonna cover that in a different video. And then another $200,000 in after-tax dollars. Then I come down here, I put down a $300,000 house. We go over to her liabilities. I threw in $100,000 in liabilities. We'll just say that $100,000 was on her home. Gives her a $1.1 million total assets. Subtract out the liability, and now she's got a net worth of $1 million. You can see this represented over here. Investment assets, 800, the house, 300, 1.1 million minus the liability for a total net worth of $1 million. So now let's go ahead and jump over to her current scenario and see what her income needs and if she's going to outlive her money or not. Now we're on Chris's current scenario. Chris's biggest concerns are, make sure I don't outlive my money, make sure that I'm not taking too much risk in the stock market. I want to get the greatest returns with the least amount of risk. Maybe a lot of you can relate to that. Tony, I don't want to pay unnecessary taxes. Help me maximize my Social Security. Tell me all the things I need to be doing in retirement planning. So the first thing that we're going to look at is Chris's income. So I'm going to hit this button here in just a second. We're going to run what's called 1,000 trials. If you've watched any of my other videos, you'll see that this represents sequence of returns of those 30 years that Chris is going to be in retirement. So let's click this button, and it's going to show us the probability of success that Chris is going to outlive her money or not. You can see she scores a 99, which represents the best possibility score that she could get. Warren Buffett, Jeff Bezos, nobody can score higher than a 99. So Chris is doing fantastic. I'm not worried about Chris at all. Most of my clients are living well within their means. Chris is living almost off of her Social Security alone and slightly dipping into her assets. So I am not worried about Chris's income at all. So the next thing that we want to take a look at is let's take a look at Chris's risk tolerance in her investments. So let's jump over to that screen right now. Now we're on Chris's risk score screen. This is very, very important because what I find is a lot of times prospects, clients are asked poor questions and then they give poor answers back. This can be really bad to your overall retirement plan. Let me explain. So if a score of 1 represents little to no risk and a score of 100 represents very risky, and someone says, where do you fall on this scale? Most people will say, and tell me if this is you, well, I'm somewhere in the middle, Tony. I'm kind of in this moderate range. Well, that's very dangerous. I believe, in my opinion, you need to know and have an investment risk score. It's vital to make sure that you know exactly where you're at, gives you high probability so you know specifically in a down market of how much in dollars your portfolio can be. If you say something like, I want to be earn 5 or 6 or 7%, but you don't understand in dollars what that could cost you in a down market, that's very, very dangerous. So let's take a look at where Chris is at. I asked Chris a few questions and she answered these and she scores out a risk of 30. Now, we have software in addition to this one here that asks about 7 to 10 different questions. we want to give you access to that. Doesn't cost you anything. You don't have to register or log in. You simply can go to the website that we link down here below, check it out, and you can get your own specific score for you and your family. It's super important to understand, in my opinion, to have a successful retirement plan. So Chris scores out a 30. This is what she wants. This is where she wants to be. No more risk. So in dollars, if we take a look at that, in a down market, let's just say a Great Recession, we don't know what's going to happen in the future, but during a Great Recession between November 2007 and February of 2009, this portfolio had a loss of less than 5%. Now, Chris is going into retirement, remember, she doesn't want to take unnecessary risk, and she doesn't want to lose a lot of money. What does 4% represent? People don't think in percentages. What do they think in? Dollars. So this would represent a loss of about $30,000. This is what she can tolerate. So if I come to our last screen, let's recap really quick. Chris doesn't understand the risk that she's currently taking. The market's been good to her, so she's seen a lot of upside until 2022 when she got hammered with some big losses and doesn't understand why. Remember, she only wants a risk score of about 30, but technically she's in a much more aggressive portfolio that scores out about a 70, completely out of her risk tolerance where she wants to be. So I have 9 different portfolios up here on the screen. You can see Chris's towards that bottom side. The very top represents very conservative, and the bottom represents the most risky. She's currently towards the bottom of this with 80% in equities or in stocks. She can earn maybe about a 6% rate of return, has a standard deviation of 15%. But where she wants to fall into place, where she feels comfortable with, is a portfolio way towards the top, much more conservative, a capital preservation portfolio, projected return of 4%. Now that may be a little bit less, but it doesn't have huge losses. This is the importance of understanding and getting your investment risk score, knowing a specific number, not saying, well, I'm moderate, I'm somewhere in the middle. That's very dangerous in retirement planning. So that's today's tip for you. Make sure you get your risk investment score. Again, you can check out the link below. We're going to put it at the bottom of the screen. You can go out to that website. You can get it. You don't have to log in or do anything like that, and get your specific score. Remember, always consult a licensed professional who understands your specific goals and dreams.